Everyone wants to get rich investing. We all do. But in 2025, a lot of people are doing the exact things that quietly, almost silently destroy their wealth. And it's not because they don't try hard enough, it's because they don't even know what's holding them back. In a year that's packed with opportunity, these 5 common mistakes can cost you the very future you're trying to build. So in this explainer, we're going to break down exactly what they are. Stay with us until the end. This might just be the most important financial reality check you'll get all year. In today's world, we're all investors, right? We're scrolling our apps, we're tracking the latest trends, and we're telling ourselves we're making moves. But this slide asks the really critical question, is all that activity actually getting you anywhere? It's so easy to confuse being busy with being strategic, chasing headlines, jumping from one hot stock to the next. It feels productive, you get that little dopamine hit from making a trade, but your portfolio, it might just be spinning its wheels. We have to remember that real wealth isn't built on all that daily drama, it's built on a quiet, consistent plan that just compounds over time. All right, so to get you on that path to actual progress, we're going to navigate the 5 biggest wealth traps you absolutely need to avoid. We'll kick things off with the paralysis trap, then dive into the emotional roller coaster, the trap of overconfidence, the dangerous all-in gamble, and finally, we'll talk about using the wrong tools for the job. Let's get right into the first one. Okay, trap number 1. This one is arguably the most destructive of them all. It's the paralysis trap. You can think of it like a black hole of doing nothing, where fear, uncertainty, and that endless search for the perfect moment to invest just stops you before you even start. It is the silent killer of financial futures, because the cost of waiting is a price you can never, ever get back. So how many of these sound familiar? Be honest. You can turn on the news any day of the week and find a dozen reasons not to invest. Inflation, elections, global conflicts, whatever the flavor of the month is. Headlines are literally designed to create uncertainty. But here's the reality. Uncertainty is the only constant in the market. There will always be a reason to wait. In 2020, it was a pandemic. In 2022, it was inflation. In 2024, it's election fears. Every single year presents what feels like this unique, unprecedented reason to stay in cash. But the investors who actually succeed are the ones who get that these are features, not bugs of the system. I mean, think about it. Investors back in 2015 thought the S&P 500 was too expensive then. Waiting for all the lights to turn green just means you'll be standing on the sidelines forever. And this classic quote just says it all. It gets right to the core truth of investing. Every single day you spend on the sidelines waiting for some perfect entry point is a day you lose to the most powerful force in all of finance, compounding. The market does not wait for you to feel comfortable, and the economy will never be perfect. The key takeaway here is simple. Starting small right now is infinitely more powerful than waiting to start big later, because the one asset you can never get more of is time. Okay, let's make this real. Look at that number, over $1 million. This is what's possible if you invest just $200 a month. That's less than a daily fancy coffee, starting at age 22. Now get this. If you only do that for 8 years until you're 30, and then you never invest another dime, that money, assuming an average market return, can grow to over $1 million by the time you retire. That is the magic of compounding. Your money starts making money, and then the money your money made starts making its own money. Every year you delay, you are losing your most powerful ally, time. This isn't just a missed opportunity, it's a massive, unrecoverable financial loss. So if the first trap is doing nothing, the second trap is doing way too much for all the wrong reasons. It's the classic overcorrection. After sitting on the sidelines in fear, an investor finally jumps in, but they do it emotionally. We're talking about the emotional roller coaster, letting fear and greed drive your portfolio straight off a cliff. This is where your decisions are fueled by hype instead of a plan, causing you to buy high with FOMO and sell low in a panic. You're systematically destroying your own returns. And we've all felt this. A friend is making a killing on some crypto coin, a meme stock doubles overnight, or a handful of tech giants just seem to go up and up and up. That's when FOMO kicks in, that nagging voice in your head telling you, hey, everyone else is getting rich and I'm being left behind. This emotion is a powerful trap that causes you to just abandon your strategy, ignore any real research, and pile into an asset you don't really understand, often right at the peak of the hype. It's a primal fear of being left out of the tribe's success, and man, is it powerful. For a perfect, almost painful cautionary tale, you just have to look at Yahoo back in the late 90s. The dot-com boom was on fire, and investors had extreme FOMO.
They bid the stock up until its price-to-earnings ratio, which is basically how many years of profit it would take to earn back your investment, hit an absolutely insane 11,000. Now, for context, a healthy company might have a PE of like 20 or 30. This was pure fantasy, but people piled in anyway. And what happened? Well, despite its growth, the stock couldn't defy gravity forever. It crashed, and its value just evaporated. The lesson here is clear. FOMO makes you pay an absurd price for a story, not for a sustainable business.
Now, on the other side of that emotional coin from greed is fear. When the market inevitably pulls back, two mindsets emerge, just like this slide shows. The amateur investor, they see red in their portfolio and their first thought is, oh my God, I'm losing money, I have to get out. So they sell, locking in their losses. But the disciplined investor sees the exact same 10% drop and thinks, wait a minute, the world's best companies are on sale. This is a buying opportunity. It's all about reframing a crisis as an opportunity. Your mindset in these moments is what ultimately determines your long-term success. And this chart shows you exactly what happens when you let fear win. Just look at 2018. The market dropped 6% amid all these concerns over trade wars and interest rates. A lot of people panicked and they sold right at the bottom. But by doing that, they missed the massive 31% rebound in 2019 and then the 28% gain in 2021. This is such a critical insight. Some of the absolute best days in the market happen right after the worst days. By selling in a panic, you're not just locking in a loss, you are almost guaranteeing you'll miss the powerful recovery that pretty much always follows. So let's say you manage to survive that emotional roller coaster. You might fall right into our third trap, overconfidence. This one's subtle, but it is incredibly dangerous. It often strikes right after you've had some success, especially in a bull market. Maybe you bought that dip in 2018 and you rode the wave all the way up. You start to confuse a rising tide lifting all boats with your own investing genius. And this is when winning starts to set you up for a catastrophic loss. So this kind of hubris, it usually shows up in three ways. It starts with simple overconfidence, thinking you have some special skill just because a few of your picks went up. Then it evolves into over-precision, believing you can perfectly predict a company's future earnings down to the penny. And then comes the most dangerous stage of all, confirmation bias. You become so attached to your ideas that you only seek out information that proves you right, creating this dangerous echo chamber that completely seals you off from reality. And this is where that timeless quote from the great Benjamin Graham is the perfect antidote. In the short term, he said, the market is a voting machine. It's driven by popularity, by hype, by what's cool right now. An overconfident investor thinks they can outsmart the crowd and win this popularity contest. But Graham reminds us that in the long run, the market becomes a weighing machine where a company's true fundamental value is all that matters. Overconfidence makes you play the short-term voting game, while true wealth is built by focusing on the long-term weight. So let's have a quick reality check, because what we see online is often a total fantasy. Social media is just filled with people bragging about 20, 30, even 50% returns. That is not normal. As this slide highlights, the historical average for a solid long-term portfolio is somewhere around 7 to 10% per year. When your expectations get warped by all that social media hype, you start taking dangerous risks to chase those numbers. Using leverage, buying speculative assets, you're basically gambling instead of investing. A plan that only works in a raging bull market isn't a plan at all. It's a lottery ticket. And you know where that overconfidence often leads? Straight into trap number 4, the all-in gamble. This is what happens when you become so sure of a single stock, a single sector, or a single idea that you abandon the single most important principle of risk management, diversification. It feels bold, it feels exciting, but it's one of the fastest ways to lose everything. Now, take a good look at this portfolio because for a lot of people, this is what their accounts actually look like today, whether they realize it or not. After years of incredible performance, big tech has just grown to dominate their holdings. This is concentration risk, plain and simple. It's a portfolio that's dangerously focused on just one hot sector. And yeah, while that felt amazing on the way up, this severe lack of diversification makes it incredibly fragile. When that one sector inevitably cools off, the entire portfolio goes down with it. Now, contrast that with a properly diversified all-weather portfolio. Just look at the balance. It has US stocks, sure, but it also has international stocks to capture growth in different economic cycles. It has bonds for stability when stocks fall and real assets as a hedge against inflation. See, diversification isn't about being sexy, it's about being smart. The goal isn't to perfectly predict the next big winner. The goal is to build a portfolio that is resilient enough to survive when you are inevitably wrong. That is how you build lasting wealth.
finally, we come to our fifth and final trap, which is less about psychology and more about the fundamentals. It's using the wrong tools for the job. You could have the perfect mindset and a diversified plan, but if you're mismanaging your cash and your accounts, you are still setting yourself up for failure. This includes everything from holding way too much cash to treating your retirement account like a casino. Let's start with the problem of holding too much cash. It feels safe, right? But that safety comes at a massive price. This chart says it all. If you invested just $100 in the stock market back in 1980, it could have grown to over $17,000. That same $100 in safe government treasuries, just $694. By staying in cash, you aren't just losing to inflation, you are forfeiting decades of powerful growth. This is the staggering opportunity cost of fear. The solution here is actually pretty simple. Give every dollar a specific job and use the right account for that job. As this table shows, a high-yield savings account is for one thing and one thing only: your emergency fund. That's it. Your 401k and your Roth IRA, those are for long-term, set-it-and-forget-it growth. They are not for reacting to news headlines. And your brokerage account is for more flexible, goal-based investing. Misusing these tools, like day trading your retirement or keeping your life savings in a checking account, is a guaranteed recipe for financial failure. So let's bring it all together. The real rules of wealth are timeless, and they're simple. It's about choosing discipline over daily drama. It's about being consistent with your contributions, not trying to be perfect with your timing. It's about understanding that your wealth is built over decades of time in the market, not by trying to time it. It's about using diversification as your shield against uncertainty. And finally, it's about preparing for the future instead of trying to predict it.
So, we'll leave you with this question to really think about. What is the one financial mistake you are committed to stop making in 2025? Building wealth isn't about being perfect. It's about avoiding the traps that keep most investors stuck. If you can eliminate these 5 mistakes, you're already ahead of 90% of people trying to grow their money in 2025. Start consistent, stay disciplined, and let time and diversification work in your favor. If this explainer helped you see your financial habits in a new light, like it, subscribe, and share it with someone who needs to hear this message.